Welcome to the Deep Dive, where we cut through the noise to deliver those aha moments you need to feel truly well informed. Today, we're tackling a topic that touches every single one of us: our personal finance and investment toolkit. We've compiled a fantastic stack of sources for this deep dive, primarily a really insightful Q&A from Grind and Grow Daily that answers some of the most pressing money questions out there. And as we jump in, I want to ask you, our listener, directly. Why does financial literacy feel like, well, almost a superpower in today's world? Because let's be honest, the world of money can feel overwhelming, complex, even a little intimidating sometimes. Our mission today is really to equip you with the knowledge to make informed decisions and truly take control of your financial future. It's about turning that overwhelm into empowerment.
That's precisely it. Think of us as your guides here. We're here to extract the most important, often surprising, nuggets of knowledge from these sources. Our goal is to help you navigate this world with clarity and confidence, ensuring you avoid common pitfalls and maybe seize opportunities. The core reasons financial literacy matters, as our sources powerfully highlight, aren't just about making good decisions, but about escaping those insidious debt traps and building a robust foundation for long-term stability and genuine financial freedom.
Okay, let's unpack this. A lot of us know we should manage our finances better, but the question is always, where do you even begin? If you're standing at the starting line, what's that absolute first step you should take before anything else? It can feel like there's just a mountain of advice out there.
Yeah, it can. And it's often the simplest yet most overlooked step: tracking your income and your expenses. Seriously, this isn't just busy work. It's like installing a GPS for your money. Understanding precisely where your money comes from and, maybe more importantly, where every single dollar is going. That's the non-negotiable foundation. Without that clear picture, you're essentially trying to plot a course without a map. I mean, most people are genuinely surprised when they see their actual cash flow for the first time.
That makes so much sense. Like, you can't fix a leak until you know where it is, right?
Exactly.
So once you have that clear picture of where your money is going, the next layer of complexity often comes up: the difference between simply holding money and truly making it work for you. I think many people, maybe myself included sometimes, often mix up saving and investing. What's the real distinction there?
Yeah, it's fascinating how often these two, crucial concepts get conflated, yet they serve very different purposes. Saving is primarily about preserving money for your short-term needs or emergencies. Think an emergency fund, maybe a down payment on a car next year, or that vacation you're planning. It's about security and accessibility. Investing, on the other hand, it's about actively growing your wealth for long-term goals. This is where you put your money to work, aiming for significant growth over years or even decades for things like retirement or maybe a child's education. And here's a crucial insight. Not investing for long-term goals is itself a kind of loss because of inflation, even if your savings account balance looks stable. The real win is understanding how to make your money actively fight inflation for you.
Okay, so saving is for the near future, stability. Investing is for the far future, growth and beating inflation. Which brings us to a big question that probably everyone wonders. How much of your income should you actually be saving or investing? Is there like a magic number or a good rule of thumb we can follow?
Well, there's a widely recommended practical guideline known as the 50-30-20 rule, and it's a fantastic starting point. Really useful. It breaks down like this. 50% of your after-tax income should ideally go towards your needs essentials like housing, groceries, utilities, transportation, the must-haves.
Okay.
Then 30% is allocated for your wants, things like dining out, entertainment, subscriptions, hobbies, the fun stuff.
Right.
And finally, that crucial 20% should be dedicated to savings and investments. Now, I'll add a little nuance here. For someone in a high cost of living area or maybe just starting their career, 50% for needs might feel, well, impossible.
Yeah, I can see that.
So this rule is a flexible guideline, right? Not a rigid law. The core principle is establishing healthy habits and prioritizing that 20% for your future, even if you need to adjust the percentages slightly in the short term. The important thing is to consistently put something away.
That's a great practical framework. Very helpful. So with that foundational understanding of your money, where it's going, and the crucial difference between saving and investing, the natural next step is putting it to work. But for a beginner, the world of investing can seem like a dense jungle. Where's the safest, most effective path to start? What do the sources say?
Uh-huh. For beginners, the recommendation is almost universally to start with low-risk, broadly diversified options. Then you can gradually increase your exposure as you learn more. When we talk about safest options for starters, our sources specifically highlight things like fixed deposits, government bonds, and index funds.
Or can you break those down a bit?
Yeah, sure. Fixed deposits are essentially you lending money to a bank for a set period, and you receive a guaranteed interest rate. Pretty straightforward. Government bonds are similar, but you're lending money to the government, often considered very, very safe. And then there are index funds, or ETFs, exchange-traded funds, which trade like stocks but hold lots of different things. These are fantastic because they essentially allow you to invest in a broad basket of companies that track a specific market index, like the S&P 500. This gives you instant diversification without having to pick individual stocks, which significantly lowers your risk while offering, general market returns.
That clarifies so much. It sounds like a great way to dip your toes in without diving headfirst into something really complex. Now, let's talk about the long game, particularly for those just starting their careers. Planning for retirement often feels like something for future you, but I've heard starting early is paramount. What about planning for retirement, especially if you want to start young?
Oh, it's not just important. It's truly the game changer. And it all boils down to the almost magical power of compounding.
Oh, yes, compounding.
Think of compounding like a financial snowball. You start with a small snowball, your initial investment. As it rolls down the hill, it picks up more snow, your earnings, and then that bigger snowball continues to pick up even more snow, growing faster and faster over time. It really accelerates. So the earlier you start investing in retirement accounts or pension funds, the more time your money has to grow exponentially. To put that in perspective, consider this. An extra, say, $100 invested every month starting at 25 compared to starting at 35 could mean hundreds of thousands of dollars more by retirement purely because of those extra 10 years of compounding.
Wow, that's huge.
It really is. It's often called the eighth wonder of the world for a reason. Time is your biggest asset.
That numerical example truly makes the magic of compounding hit home. It really underscores the importance of time. Now, when we talk about investing, there are often different philosophies or styles, right? What's the difference between active and passive investing, and why does that matter for someone just starting out?
Right, these are two major approaches. So active investing involves frequent buying and selling of individual stocks or other assets. The goal is usually to try and beat the market through strategic timing and selection. It requires a lot of research, a lot of time, and often comes with higher fees.
Okay, sounds intense.
It can be. Now, passive investing, on the other hand, focuses on long-term growth by investing in broad market indexes, typically through those index funds or ETFs we just talked about. You're not trying to outperform the market. You're simply aiming to track its overall performance. Ride the waves, so to speak. If we connect this to the bigger picture, passive investing often aligns incredibly well with a beginner's approach. It's generally lower cost, far less time-consuming, and honestly, historically, most active managers actually struggle to consistently beat the market over the long run. So passive investing ends up being a very kind of hands-off strategy for long-term wealth building for many people.
That's a powerful distinction, especially for those who don't have the time or, frankly, the desire to constantly monitor the market. And speaking of reducing risk, the word diversification comes up constantly. How important is it really in investing, and what does it actually mean in practice?
Oh, it's absolutely crucial. Diversification is your primary shield against volatility. It's fundamental risk management. It basically means spreading your investments across various assets, different types of stocks, different industries, bonds, maybe even different geographic regions.
Okay.
The goal is to reduce the impact of potential losses from any single investment.
Yeah.
If one asset performs poorly, your entire portfolio isn't wiped out because other assets might be doing okay or even well. Think of the old saying, don't put all your eggs in one basket. That's diversification.
Simple but effective.
Exactly. Our sources even mention real estate as a potential investment option, but they rightly caution that its success depends heavily on location, timing, and your financial capacity. It's not a guaranteed win. And even within real estate, you'd ideally want to diversify your holdings if possible, like maybe owning properties in different areas or types. The key takeaway is, spread your bets to smooth out the inevitable ups and downs of the market. It increases your odds of long-term success.
Got it. Spread the risk. So we've talked a lot about building wealth, but what about the common traps people fall into, those unseen landmines that can derail even the best financial intentions? Let's turn our attention to what to avoid. What are some of the biggest money mistakes people make that you, our listener, can try to avoid right from the start?
Yeah, that's a really important area. Our sources highlight a few recurring errors that are surprisingly common. The big ones are living beyond your means, basically spending more than you earn. This often stems from, a desire for instant gratification or keeping up with others.
Mm-hmm. Lifestyle creep.
Exactly. Then there's ignoring the absolute importance of an emergency fund, which we should probably talk more about.
Yes, definitely.
And finally, chasing quick, unrealistic returns, falling for those get-rich-quick schemes, instead of focusing on consistent, disciplined, long-term growth. These are the temptations and blind spots that can really undermine even the most well-laid financial plans. Easy traps to fall into.
That makes perfect sense. The lure of instant gratification is powerful, isn't it? You mentioned emergency funds. Let's dive a little deeper there. Why is an emergency fund so essential, not just a nice to have?
Right. An emergency fund is your financial shield. It's a non-negotiable safety net, really. It protects you against life's inevitable curveballs. Sudden medical bills, urgent home or car repairs, or, critically, a period of job loss. Things you can't always predict.
Yeah, the unexpected.
Exactly. Having this fund, typically 3 to 6 months worth of essential living expenses, saved in an easily accessible safe account, like a high-yield savings account, means you don't have to go into high-interest debt, like credit cards, during these crises. It preserves your other investments, prevents financial stress from spiraling out of control, and maintains your overall financial stability. It's the bedrock of peace of mind. Truly.
That security aspect sounds invaluable. And building on that idea of protection, what role does insurance play in this whole financial planning puzzle? Is it just another expense or something more fundamental?
Insurance is absolutely fundamental. Think of it as another, often critical layer of protection for your accumulated wealth and, importantly, your future earnings potential. It shields you from significant, catastrophic risks that could otherwise devastate your finances. Think major health issues, unforeseen accidents, disability, or even premature death affecting your family's income.
The really big hits.
The really big ones. While it's an expense, yes, it's really an investment in protecting your financial independence and everything you've worked for. Without adequate insurance, a single catastrophic event could wipe out years, maybe decades of saving and investing, forcing you to start from scratch or rely on others. It's a crucial safety net for the worst-case scenarios.
Okay, so emergency fund for the smaller shocks, insurance for the potential catastrophes. Makes sense. Let's address some external factors that are always impacting our money, often quietly in the background. How does inflation affect your personal finances, and why is it so important to understand? And then, what about taxes? How do they impact investment returns, and what should we be aware of?
Right, two big ones. Inflation, simply put, is the silent erosion of your purchasing power over time. What $100 buys today will buy less next year and even less the year after that.
It just eats away at savings.
It does. And this is precisely why investments are crucial. They give your money the potential to grow at a rate that at least keeps pace with, or ideally outpaces, inflation. This helps preserve and grow your wealth in real terms, what it can actually buy. Just saving cash under the mattress, or even in a very low interest account, means your money is losing value every single year.
Okay, so investing is key to fighting inflation. What about taxes?
And yes, taxes are another significant factor. They can reduce your investment returns significantly, sometimes by a substantial percentage, depending on the type of investment and how long you hold it.
Ouch.
Yeah, which is why understanding tax-advantaged accounts, things like 401ks, IRAs, or similar retirement funds in your country is so important. And engaging in careful tax planning, maybe working with a professional, can help minimize that impact and maximize your net gains over the long term. It's about being strategic with how and where you invest.
Got it. Be aware of inflation. Be smart about taxes. Okay, shifting gears slightly to debt. It's a reality for many and often feels like a heavy burden. But a good credit score is so important for so many financial doors: getting a loan, renting an apartment, sometimes even jobs. How can someone improve their credit score, especially if it's maybe taken a hit?
Yeah, improving your credit score involves a few concrete and consistent steps. It's all about demonstrating responsible financial behavior over time. The primary one is paying your bills on time, every single time. Consistency is absolutely key here, as payment history is usually the biggest factor in your score.
Right. No late payments.
Not if you can help it. Then, actively working to reduce your existing debt is crucial, especially high-interest debts like credit cards. This lowers your credit utilization ratio. That's how much credit you're using compared to how much you have available, and a lower ratio generally helps your score. And finally, avoiding unnecessary credit inquiries. Every time you apply for new credit, it can cause a small temporary dip in your score. So only apply when you genuinely need it. It's definitely a marathon, not a sprint, but these actions build a strong foundation for a better score over time.
That's good, actionable advice. And once you have existing debt, which many people do, what's the best strategy for tackling it? Because it can genuinely feel like an impossible mountain that's just getting bigger.
Absolutely. It can feel overwhelming. Our sources outline two popular and effective methods, and the best one often depends on your personality and your specific financial situation. There's the snowball method. With this, you focus on clearing your smallest debts first, regardless of the interest rate.
Okay, the little ones first.
Right. The idea here is to gain motivational wins quickly. As you knock out those smaller balances, you feel a sense of accomplishment, which builds momentum and keeps you going. Psychological boost.
I can see the appeal of that.
Definitely. The other main one is the avalanche method. This focuses on paying off your high-interest debts first, while making minimum payments on the others. This approach saves you more money in the long run because you're attacking the most expensive debt first, reducing the total amount of interest you pay over time.
Mathematically better, maybe?
Mathematically, yes, the avalanche method usually saves more money. So it's really a choice between those quick psychological boosts with the snowball or the pure mathematical savings with the avalanche. Both are effective strategies if you stick to them. It's about finding what works for you and helps you stay consistent in paying down that debt.
That's a really helpful breakdown, offering different routes up that mountain depending on what motivates you. Very clear. Finally, after everything we've discussed today, tracking, saving, investing, protecting, managing debt, if we could distill it all down, what are those consistent financial habits that truly lead to long-term wealth? What's the secret sauce?
It really comes down to a trio of core principles, applied consistently over time. No big secrets, just discipline. First, consistency in saving, making it a non-negotiable part of your budget, like a bill you pay to your future self first. Automating it helps hugely.
Pay yourself first.
Exactly. Second, disciplined investing. Sticking to your long-term plan even when the market gets scary or volatile. Resisting the urge to panic sell or chase hot trends based on short-term news. And third, actively avoiding unnecessary expenses. This means being mindful of where your money truly brings you value versus just being spent thoughtlessly or habitually. Conscious spending. These aren't flashy or complicated, are they? But they are the bedrock habits that, when applied consistently over time, really leverage the power of compounding and build significant long-term wealth. The real secret, if there is one, is simply doing them. Day in, day out, month after month, year after year.
That's powerful. Consistency, discipline, mindfulness. So what does this all mean for you, our listener? We've covered a vast landscape today, haven't we? From the absolute basics of just tracking your money and understanding saving versus investing, all the way to the nuances of strategic growth, protecting your financial journey, mastering debt, and cultivating those really crucial lasting habits. It's been a truly comprehensive deep dive into building financial control and confidence.
Indeed it has. And if I were to offer the single most impactful piece of financial advice from all of our source material, the one truth that kind of underpins everything we've talked about, it would probably be this: live below your means, invest regularly, and let compounding work its magic for you. Those three actions, consistently applied, really form the immutable bedrock of financial success and ultimately financial freedom. They are the keys to unlocking your potential.
Live below your means, invest regularly, let compounding work. Simple, but profound. As you reflect on today's deep dive, maybe consider this: knowing the incredible power of starting early and letting compounding do its heavy lifting. What one small financial habit could you start, or maybe even stop, this week to begin leveraging that immense power for your future? Whether it's tracking your expenses for just 5 minutes a day, setting up that small automatic transfer to a savings or investment account, or maybe canceling one unused subscription, that first step is often the most powerful one. Thank you for joining us on the deep dive.